gents. We'll get cracking with the second half of the event. I know a few people will be drifting back. Tearing people away from a free bar is much easier said than done. But what we're going to do is we're going to have a panel discussion with three of the best market minds that I know. Sadly, they weren't available this evening, so we've ended up with these three instead. Joining me is... joining me, we've got Richard Matthews, who's the head of FX payments and partnerships at One.io. Have I got that right? Yeah, the world's longest job title. Yes. We've got Ryan Littlestone, who I'm sure some of you are familiar with, who co-hosts The Trade-Off with me every week, who has been trading the markets for many a year now and is from Forex Flow Live and Forex Analytics. And last but by no means least, Adam Linton, who is the head of the European desk over at News Squawk, who... If you don't already subscribe, I'm not going to give them an advert, but I will say they are an integral part of my daily market routine, and I don't think I could do my job without your dulcet tones in my ear every day. What we hope to do over the next half an hour or so is give you a diverse range of perspectives on the markets and the macroeconomy. We've clearly got a diverse range of sartorial standards going on the stage here. Ryan obviously didn't get the memo around wearing a proper shirt today, but we'll let him off and hope he can add some value nonetheless. So I want to start with a macro, and I'll start with you, Ryan, give you a chance to redeem yourself. One of the biggest themes of the year, and really last year as well, has been this idea of US economic outperformance, US exceptionalism. How long can that continue?
Tomorrow? That's the big question. It's been very strange that you see a central bank raising rates so high, so fast, and nothing really happens to the economy. So I think it's one of those situations. I've still got a niggle in the back of my mind where it's either going to hit the wall really fast, or we're going to see, like we're seeing in Europe and UK, where it's just a gradual weakening, or it doesn't weaken at all. So, I mean, at the moment, all signs point to positive. And as I like to say, the trend is your friend. So until we start to see things change, and there are a couple of things I've seen starting to change, the auto sector, we looked at that on the show, the consumer, which looked like it might be wobbling, and then we had that bumper retail sales coming out that put pay to that. So I think it's going to continue for a while longer, but I don't think it's going to last forever. Maybe later in the year is when we start to see a few more cracks appearing.
No, that's interesting. I mean, nothing can last forever, can it? Let's be honest. But particularly on inflation, I think that's one of the most interesting things to me at the moment. Obviously, we had 2022 where inflation was shooting higher after the pandemic, after COVID, central bankers saying it's transitory, it's temporary, then hiking rates really rapidly to try and get back in control of the situation. We seem now in a situation where, and I'm going to throw this one to you, Dick, because you're the only one here who was here during the 70s inflationary spike, unfortunately. Where do you think we go next? Because central bankers now, particularly in the United States with the Fed, we've had that hotter than expected CPI number last week at 3.5%. It seems like 3% on headline CPI is now a floor rather than a ceiling as it was previously. So how difficult is it going to be to get inflation back to that 2% target, do you think?
I don't think they will. I think that they will actually change their target. They'll bring it to 3%, and they'll aim to get it down to 3%. I think there's huge inflationary pressures in the markets from oil, commodities, et cetera, et cetera, et cetera. And actually, it's quite interesting that you do refer to the longevity of my career. That I was just saying to Adam that when I started in 1973, I had a very similar scenario: geopolitical risk, Arab-Israeli conflict, oil prices go through the roof. Massive inflation comes in. And I think that, to me, is the danger to the whole economy, and the interest rates, as you well know, I'm the only one probably in this room, probably in this city, has been saying, I think the Fed will raise interest rates this year. I think it'll be a long time, definitely, before they come. Now, I still think they might raise them, and I think that's what bursts the bubble of the economy. And I don't think, actually, that you'll get a proper recovery until you get a recession. And I think almost it's like burning the woods down, or having a forest fire, and it has to clear the debris before you get a really, really good recovery.
Yeah, it's an interesting point, and I guess it speaks back to something that's been discussed at length, and we certainly won't have time to discuss it this evening. Is, was COVID actually the end of an economic cycle, or did it just prolong where we've been since 2008? But that's opening a whole can of worms that we really don't have time to get into. Adam, I want to bring you into the conversation because we're sat here talking about the US economy. Consumer spending is very, very strong. GDP growth has been running at north of 2% on an annualized quarterly basis for the last 6-7 quarters in a row. The labour market is incredibly tight. Earnings growth is very, very solid. If you brought up a dashboard of the US economy, almost everything would be green. Now, your focus is primarily on the European and the UK economy. I don't think you could say those dashboards are quite as green as you would for on the other side of the Atlantic, can you?
Well, no, in short. I mean, I think we're still waiting the Q1 Eurozone GDP at the end of the quarter. But from a Eurozone perspective, in terms of some of the survey data, it does look like things are bottoming out. We've got the composite PMI back above 50, manufacturing's back above 50. But in terms of growth from a Eurozone perspective, it's only going to be relatively modest and relatively downbeat because Germany's faltering at the moment. If you look at metrics such as industrial production, things really aren't looking good from a German perspective structurally. But in a policy space, there's something that ECB can actually do with this because they're actually having some success with inflation. We're at 2.4% now. It's only just above the 2% threshold. And yes, there's some sticky elements such as services inflation, which is at 4%. But if you look at things like bank lending, I think their easing is doing relatively, their tightening has accomplished the objective they're looking to do. And that's why they'll be able to start cutting rates. I think the thing is how stimulative are those rate cuts going to be, and are they going to make much difference? Because at the moment, we're just in restrictive. Even if they cut a couple of times, it'll still be restrictive. And it's kind of, what's that final destination? Do they get to neutral or something more easier? And as I think, ECB is now the dovish across the majors, and I think that's been reflected in what we've seen in financial markets. You've got the Fed that's most hawkish, and I think the BOE is kind of caught somewhere in between that.
I think you're right. I didn't want to bring up the Bank of England with Mr. Matthews with us, but since you've brought it up, we're going to anyway. Dick, where do you see the BOE at the moment? I mean, as Adam said, the ECB they say they're not pre-committing to a rate path, but for all intents and purposes, they're going to deliver that first cut in June, and they're probably going to cut 2, maybe 3 more times this year. The Fed, the dot plot says 75 bips of cuts this year. Markets price around about 40 basis points when I left the desk earlier on. Certain people are even talking about the potential for another hike. If you put those at either end of the spectrum, where do the BOE fall within that? And when does Andrew Bailey go, now is the time to begin reducing bank rate?
I thought you were going to say now is the time for me to go.
Well, in your dreams, maybe.
Too rude about Andrew Bailey. I think they're stuck in the middle. I think, to me, there's clear signs of stagflation in the UK. Inflation's still too high. I think that the price rises that we all know that are coming through on mobile phones, TVs, et cetera, is going to actually push inflation back up. I think petrol prices are going to go higher. And then you've got the state spending. Certainly my pensions increases this week. And lots of public sector employees pushing wages higher. So you've got the wage push there. Services inflation, despite the best wishes of Rishi Sunak, is still around about 6%, which is too high. And then you've got unemployment starting to grow. So to me, it's absolutely clear signs of stagflation. I think they're stuck between the devil and the deep blue sea. I think they'd like to cut. I can't see that they can with inflation this high. I think that it's a problem.
Go on, Mr. Linton.
I think the one thing I was going to add to that is for the Bank of England as well, they're going to have a pretty hard comms exercise over the coming months because headline inflation is going to be below 2%. And that's what we're going to see in front of all of our newspapers. But as Dickie said, services inflation is the real sticking point. That's at 6%. And by the summer, that could only fall down to maybe 5-4%. And so it's how they kind of communicate to the wider masses that, no, service inflation is the thing here, even if we are below 2%. And I think, we don't really hear too much from the Bank of England. Their communication isn't the best. And they're very split in what they think at the moment anyway. So I think the Bank of England, out of all the majors, I think that's the hardest one to call by quite some distance.
And also, we don't know when the election's going to be. And I think that plays a big point in the Fed and with the Bank of England. And the Fed, the US election is November
5th of November, yeah.
Yeah, Guy Fawkes Day. Perfect.
Indeed. This wasn't on our script, but I'm going to ask it anyway. Ryan, politics is going to become a big thing later on this year. We've got an election. Well, we've got European elections in June, if anyone cares about those. We've got UK elections at some point this year. Could be summer, could be October, could be November. Depends which newspaper you read. US elections on the 5th of November. How do you think that is going to impact the financial markets, maybe not just the foreign exchange space, but more broadly, perhaps in terms of volatility as we move through into that election season?
Yeah, I think the US election is going to be volatile. We all know what Trump's like. We all know what he was like in his last tenure. If he gets in again, I don't think the market's going to be too happy with that generally. Depends how it gets dumbed down afterwards. As for the UK, it's always the case in the UK, if there's uncertainty with the election, that brings the most problems for UK assets and the pound. If it's a hung parliament, no clear winner either side. I don't think that's going to be the case. I think Labour's probably going to clear up just because of how bad the Conservatives are going to be. But there is still a risk that a lot of the other minor parties get a good share of the vote and makes it a little bit more messy. And the market doesn't like uncertainty. Doesn't matter if it's Labour, Conservatives, whoever. If it's one clear winner, then the market gets on with life and trades it further down the line, fiscal policy. But if it is a bit messy, that's when you're going to see problems in and it's going to be the same for the US as well. So it's going to be volatile until we get a clear winner and we know what we're doing, and then markets will probably settle down afterwards.
Yeah, no, I would agree with that. So something I want to get your views on, both of you, Dick and I, we've discussed this at length, is we're sat here talking about the Fed are going to cut rates at some point. Whether that comes not you're not. The three sensible ones on the stage are talking about when the Fed are going to cut rates. There's an outlier here.
I will say that beginning of the year, they were going to cut rates 6 times this year. Wasn't that the prognosis?
That was market pricing,
Market pricing. And we're now down to what, 1?
Maybe one
2.
and a bit, nearer 2. But what we've spoken about before is how potentially political developments and the election timing could complicate the policy outlook. So are we really in a situation where if the Fed haven't started cutting by, say, September, does that mean they're not going to cut this year because of the political landscape?
I think when it comes to politics in the Fed, I think there's a lot of people saying that the Fed won't cut in September because it'll be seen as politicizing things. I don't particularly buy that, because I think they would have ideally started cutting by June, July if the data had gone that way. I think you expressed your independence by doing the course of action, which you should. But I think one of the biggest tail risks in the market at the moment is the US election and a Trump presidency, because if you get a combination of tax cuts and you get tariffs, that's very inflationary, and therefore the Fed is going to have to lean against that. And therefore, the Dickie Matthews of the world could be right, because the world in which we speak about monetary policy is this one where inflation heads back towards 2% at some stage, growth slows, and we don't ever really think about the fiscal side of things. We just purely focus on the monetary element. And I think that's all going to be completely torn up if we do get a Trump presidency.
No, I think you're absolutely right. Go on, Ryan.
Yeah, I agree with that. And I'm actually, as we mentioned, one of the trade-offs, I'm wavering over whether they cut or not. I'm moving towards, Dickie's line of thinking, just purely because the data said so. We've been watching the data, mentioned it a few months ago, CPI has been roughly unchanged around 3%, 3.5% for 10 months now. That's not progress on inflation, whether they look at the PCE, whatever. CPI has not moved for 10 months. But as far as the Fed goes and the politicalness of whether they cut or not, they're damned Powell's damned if he does and damned if he doesn't, because if he cuts, then that's political on one side. If he doesn't, it's political on the other side. And I think one thing that we've learned from Powell since he's been there, he's become very good at shepherding the market the way he wants to do. Look at his conversation the other day. He could have come out and been really hawkish against that CPI data. He wasn't. He said, okay, we might have to stay higher for longer. And the market went, oh, all right then. And that was it. And, no real big waves from that. We already had a move before that after the CPI data. So I think it comes to a point where he's got to go, you know what, don't care about the politics. We've just got to do what we need to do. And that's probably what he'll communicate.
Why do they need to cut, though?
Sorry?
Why do they need to cut?
At the moment, they don't need to cut. They don't need to
When
cut.
it does come to rate cuts, they're very restrictive at the moment. And when they do start cutting, there'll be still an element of restrictive, just less restrictive than they are. It's not like they're going straight to neutral or sub-neutral. And I think that's one thing which can give them cover when they do want to start cutting.
No, I think you're right. But what I do want to get your views on, and this is, we'll turn to the financial markets in a bit more depth in a second, but this is something that a few on the sell side have been putting out recently, is that, we're talking about rate cuts from the Fed. Are we only talking about rate cuts because the Fed have told us that they want to cut rates this year? Because if you ignored everything the Fed was saying and you look at the data, you've got 3% CPI, you've got resilient growth, as we said, full employment, solid earnings growth, nominal and real. Consumer spending is resilient. If you look purely at the data and ignore what the policymakers have been saying, you'd say you don't need to cut.
Yeah, and we've all got to understand why they want to cut. They don't want rates this high. They want rates at a neutral, a normal level where they can then just tinker with rates as the economy heats up or slows down. So they don't want rates up at 5% because that will bring pain further down the line. The higher you keep them, the more pain there is to come. So they need to get rates down. It's just that at the moment, they're not able to bring them down. They would love to start cutting them now. They would love to see inflation near 2%. They would love to bring rates down to whatever, 2.5%, 3%, which I think is where they're going to be settling at. But they can't do it. Again, it's a credibility issue for them. They were wrong on the way up. They messed it up on the way up. And now they're getting scared that they're wrong again. We had some victory laps coming from certain Fed members. Inflation's on its way. We get it from the ECB. Inflation's on its way. But they don't want to be caught out again. If they have to hike, that's a real big problem for credibility because it will seem like they've got it wrong again.
But it will make Dick Matthews the happiest man in the city of London if they do.
And it will actually give £100 towards the Edwards Foundation for dogs.
That's very true. There are a few,
happy to win that.
there are a few charity bets riding on that one. So I want to spend the last sort of 5 minutes of the panel just talking about the financial markets in a little bit more depth. I mean, as I said in the introduction to the event this evening, the S&P 500's up 6-7% year to date. It's come off a little bit from the highs. The dollar's rallied pretty solidly against all of its G10 peers over the last, 4 months, but even beyond that. Adam, I'll turn to you first. What are the key risks and catalysts over the next 3 or 4 months that everyone should really have on the radar as driving forces of the market?
I think number one is next US inflation release. I mean, we've been talking a lot about inflation today and what we think about.
Sorry, CPI or PCE?
Well, CPI because it comes first in the calendar month. So CPI because, the last one was the biggest release we've seen of the year because of what we've been guided to by the Fed. And we're talking about our outlooks for inflation, but we're not economists. We're basically just positioning relative to what we've heard from Fed officials. So the most recent meeting, we saw Powell downplay the first two hotter than expected inflation reports at the start of the year. And therefore, as market participants, we knew that if this was hot, this is going to be the biggest thing that's happened this year. So we've now had 3 which have not gone the Fed's way. If we have a 4th, then it's very possible we'll see no rate cuts this year. Even if we get a cold one, then I don't think it's going to make too much of a difference because they want to see a string of them. So I think US CPI is the big one. I think earnings season, obviously we're heading into that. If you trade the S&P 500, it's a market cap based index. These large cap tech names, they dominate it. And Nvidia earnings is basically a macro data point at this stage in my mind. And, the margins of all these big companies, they've been propping up the S&P 500. If they falter and Fed rate cut bets, they pull back, then that could be terrible for the S&P 500. And then geopolitics, if it leads through into inflation, if inflation starts picking up and then the ECB get cold feet, and then the election at the end of the year.
Very comprehensive, as always. I love the framing of Nvidia earnings are now a macro data point. I think that's absolutely spot on, to be honest. I mean, I think it was Goldman who were calling them the single most important stock in the world. I think there was a little bit of humor in that, but there is actually some sense and some intelligence in it as well, such as the dominance that they have over the market. Ryan, what are your views on financial markets more broadly at the moment? How are you very much viewing the landscape?
Yeah, well, as a trader, I'm trading all day long. It's important to keep an ear on what's happening in the fundamentals. I think anyone else who's trading, the Fed, the ECB, whatever central bank you're trading, on the inflation front, 3% is really the pivot line. I think it's a pivot line for central banks, get that two handle on inflation, and that's when they start to take a more dovish slant or less hawkish slant. We've seen it from the Bank of Canada last week. We've had their inflation data out there, core bang on target at 2%. Macklin was a little bit more dovish in the statement than he was, in the press than he was in the statement. The ECB, we know where they are. June's the date, apparently. If they don't cut in June, that's going to be a, cat amongst the pigeons. So that's the big price risk. We've got this overhang with Iran, Israel. I hope it comes to nothing. It probably will come to nothing. It seems like it's all a bit for show at the moment. Let's hope it stays that way. If that dissipates, we'll probably see risk trades, rebalancing on that oil coming down again. And then we're all data dependent still. So every data point matters. We've got PMIs coming up. We've got the PCE coming up. You can't really marry a trade for longer than 5 minutes. We've seen the dollar strength since last Wednesday, euro dollar from 108.50, 60 down to 106s. We've had come through Powell a little more hawkish, and we haven't gone lower. So you've got to take each moment. It's very hard. I'm a long-term trader by nature. I sit in a trade for 6 months, a year, 2 years if I need to. But now I can't trust a trade for longer than a few days. And if it doesn't go my way, or if it does but doesn't go further, I'm going to lock in my profits, bring my stops up and protect what I've got. And I think that's the best way to be as a trader right now, is just don't have too much of a bias. Roll with the punches, roll with the data points, and till we get sort of clearer picture from the central banks.
No, I think that's a great point, and it pains me to say it that the first person I heard say it was my boss, Chris Weston, and I hate to give Westy any credit when I don't have to. Dick, let's wrap up the panel with you, particularly on the FX space. I mean, I know you've been possibly the biggest sterling bear and possibly the biggest dollar bull that I know over the last 6 months or so. Are you still of that mindset, and obviously short of the euro as well?
I think the obvious one is being short of the euro. I think the euro goes very close to parity. I'm not sure it will test that.
Sorry. If Dick ever says he's long euros, then it's a cry for help. So please send him a doctor or something.
It's the hostage situation. I'm long of the euro. Get me out of here. I'd still be long in the dollar. I'd still be very short of the euro, just purely on the basis that the Fed's not going to cut. The ECB is. Sterling, I think there's a bit of political risk in there. I'd be short of sterling. The yen, I probably wouldn't touch. I think there's a consortium intervention in there. Looking at risk, I actually disagree. I think we're a long way from over between Iran and Israel. I think that will rumble on. I think once the Straits of Hormuz become really difficult to pass through, then you'll see more pressure on LNG and on oil, which will squeeze inflation up. I also keep an eye on China and Taiwan. I know Michael's going to start singing Dad's Army any minute now, so I'm always accused
no one wants to hear me singing. Don't worry about that.
or humming Dad's Army. And on two things I really would watch. An odd one is money supply in the States, which has been climbing back up for the last 10 months. Interestingly, the CPI climbs up in tandem, and the bonds, 10-year bonds, 5%. I think you're going to see 5% on there.
Well, I'm glad you helped us end the panel on such an optimistic note there, Dick. So thank you for that.
I'm always optimistic.
I know you are. That does bring us to the end of that panel discussion. Hopefully that has been of use to you guys. Thank you very much to Adam Linton, Ryan Littlestone and Dick Matthews for joining me.